Like, how do you, in terms of like, talk a little bit about founding ARK and how you think about kind of the culture of ARK and what we're doing within the context of the investing landscape.
Yeah, I founded ARK for two reasons. One, to focus only on disruptive innovation, because with your help, Brett, we were identifying major opportunities all occurring at once, 14 different technologies involved, and we didn't think the world understood what was about to hit it. And in the traditional asset management world, our strategy was considered a little out there, very volatile, very risky. And our point of view was, wait a minute, the risk is not in our strategies. The risk is, if not today, within the next 3 to 5 years, the risk is in benchmark-oriented strategies, backwards-looking strategies, because of the value traps, which are populating them increasingly. So that was one reason. And then the second reason I felt we needed to start ARK was to add new dimensions to research. We were going to become the first sharing economy company in the asset management space when it came to research. And if in the traditional asset management world, a compliance department would never turn itself upside down to oversee a social media and marketing strategy and a social research strategy like I wanted to evolve. And so we knew that wasn't going to happen. And we figured, okay, well, then let's hire people who have worked at the SEC as they've been developing these guidelines for social media and marketing, which applies to research as well. And let's run with this. Let's be disruptive. Let's use the technologies that have disrupted other industries and move them into the financial services industry and become a bit disruptive ourselves. Not just to be disruptive, but because it was the right thing to do for our clients. The transparency that we have, our clients love. And that's transparency not just in research, but also in asset management. We disclose our holdings for the ETFs every day, and we disclose our trades at the end of every day. And the other part of the social strategy that was a win-win, more so than I ever dreamed at the time, was as our analysts pushed their research into social media, Twitter, LinkedIn, Medium, Telegram, any social network that they thought could help them engage with the communities they were researching. As they were doing that, what happened is the engagement we had coming back to us was amazing. In the sharing economy, if you don't give, you won't get. And most asset managers will allow their analysts and portfolio managers now, not when I was in the traditional world, but now I think they allow them to look at Twitter, but they do not allow them to actually participate.
Yeah, I remember having to get a special dispensation to access Twitter when I was researing it back in the day.
So, and LinkedIn as well. We couldn't access LinkedIn.
Right. It is. I mean, I'd say from the research side, I think having to be transparent about what you're doing also increases the quality of the underlying research. It makes the analysts share more completely internally as well as externally. You are Cathie Wood starting ARK, and I'm on the other side, and I'm saying, listen, actively traded ETFs, that's something that doesn't really exist. And also I could say to you, why are you buying Tesla when it's down below $200? It's, you're crazy. Can you talk about, even within the context of your career, how you have that kind of strong instinct for what to do and stick by your principles?
I think I learned really early in the business that when everyone is moving in one direction and they're sure that that's the way the world's going to work, and we see reasons that is incorrect and move in the other direction, the rewards can be enormous. And I learned it very early, more with my economics hat on, in the early 80s, when inflation and interest rates were in the double digits. I was very young in my career, new to the career. And I had my mentor, Art Laffer, taught me well enough, so I thought I knew how the world worked. And so I was bringing up a lot of reasons why inflation and interest rates were going to peak, and we were going into the golden age of investing. And of course, everyone wanted to hear that, but they mostly wanted to pat me on the head. They were saying that inflation and interest rates were baked into the cake at a double-digit rate, that this was intractable. And just coming up with different proof points. It actually was coming down, and nobody was giving the lower rates, lower inflation school any, and there weren't many of us, any credibility. That's when I really love it. And so active ETFs, we saw the share shift towards ETFs after the 08-09 crisis, because that's what we do. We study disruptive innovation. And we said, well, why couldn't an active manager manage an ETF? It's a wrapper. It looks like it's really good for the end investor. Better, cheaper, faster, everything we say about innovation. And so we started that way. And again, people dismissed us. Just active did not belong, active was dead. And it actually made me feel good, because I thought, wow, everybody really believes this. And I don't understand why. They really can't explain to me why. And that's because they didn't understand active management, which I didn't understand until I entered into the ETF space. We're in many wrappers now, but we wanted to democratize investing. And there's a huge intergenerational transfer of wealth starting to take place as the baby boomers retire and pass on, and this new generation really wants to understand what they're buying. They love the transparency, and they love following us on social media, especially when there's one big controversy. Tesla, of course, has been a wonderful way to showcase our research, because we were thinking that electric was possible from a scaling exponentially point of view within 5 years of the starting of the company. We started in 2014, and that certainly has proved correct. And we had the model, again, centered on Wright's law, that's critical to our analysis, such that we were watching the numbers coming out, and they were following the model that we had put in place. But because most analysts out there weren't even considering electric as relevant for 10 years, we had to convince the public. So I think our way of doing research, the courage of my conviction born out of our research, and standing on the shoulders of you and our analysts, I was able to suffer through the slings and arrows, and I didn't even consider it suffering, because I knew we were onto something big, and I know we're onto 5 big platforms. And Wright's law is working in each of them. So, those are some of the reasons.
So it's been 6 years, I guess, since you started ARK. Here we are in 2020. I guess late 2014 was the start.
Of the
6
fund.
years from of the funds, yes. Yeah. 6 years from now, what do you think the next 6 years will have in store? The next 5 years within the innovation space, within ARK?
Yeah.
What do you see?
Well, a lot of people, when we started ARK, thought we were a niche strategy. And that was fine. I liked that. Competition was going to stay away from niche. It wasn't big enough. It wasn't going to move the needle at the big houses. And and now they are starting to develop research in the innovation space as well, which we're really happy about, because we think the most massive misallocation of capital in the history of the world took place in these later days of indexation, now that more than half of stocks are in index-based strategies, we believe the pendulum has pretty much swung as far as it is going to. I say that, famous last words, who knows? But it seems as though that is true. And that this search for, okay, how is the world going to look, instead of, how is this index positioned, and shall we take 50 basis points more of that stock, or 50 basis points less? We're getting some real research now moving into the innovation space. And this niche strategy, what once people considered a niche strategy, is the way the world is going to work. These are the next, if we're going to continue with indexes, and I'm sure we will, these are the next big index stocks or benchmark stocks. And we think that we are in the early days of scaling each of our 5 platforms. In the early, genomics is the earliest, to be sure, maybe blockchain and genomics. And the others, as I mentioned, retail is only now in the United States begun to enter that sweet spot of the S-curve. So I think the next 5 years is going to be, scaling these exponential growth trajectories, and learning that this wasn't a niche strategy. This was a strategy that understood that 5 major innovation platforms evolving at the same time, again, involving 14 technologies, were going to transform the world completely. And, you have to be on the right side of change. So I believe we're going to scale exponentially during the next 5 years. And a lot of people ask us about capacity. If we're right, if our research is correct, then we should be able to scale exponentially as well.